All right. Good afternoon. Good Thursday afternoon. Uh, Here we are, September. Welcome to our first September weekly State of the Market. And seems like September is already getting a little dicey, folks. We're on a 3-day losing streak for the S&P 500. It is an SOTM day, State of the Market day. And unfortunately and usually, the market has a red print on our State of the Market days. We're probably going to have to do some data analysis on that to get a buy-sell signal off of it, but just a heads up there. All right, so the September effect, right? One thing I always like to lead off our State of the Market recordings with is some positive vibes, either a positive affirmation, an old adage, and colloquialism that lends itself positively to investor sentiment. But for this week, let's just keep it simple and know your ABCs of investing, right? Always buy corrections. If you didn't learn that in the dot-com bust, if you didn't learn that after the great financial crisis, if you didn't learn that after the fastest bear market in history in 2020 through the pandemic, I'd like to think you've learned it by now. Always buy corrections, your ABCs of investing. The S&P 500 was up by more than 20% by the end of August for the first time since 1997, and it has made a new high every single month this year so far. Incredibly, it's made 53 new highs before August was over, which was the most ever. At the beginning of September, S&P 500 made its 54th all-time high of the year. S&P 500 has made an all-time high now in 9 consecutive months. While September is historically a down month for the S&P 500, don't overlook momentum. Objects in motion tend to what? Exactly. Stay in motion. Here's a chart going back to 1928 for the S&P 500, the monthly calendar, and unfortunately there's September. It's worth noting that both September's up-down count and its average return are greater than 2 standard deviations from the mean. The 2 sigma levels are 43 down days and a 0.9% negative return for the month. So what's the takeaway? The historical data confirms there is something special about September, but at a mean return of negative 1%, this fact falls into the good to know category or bucket, rather than something that proves, terribly concerning. Like, what's a 1% decline in the grand scheme of things? Moreover, the Yardeni chart that you see before you here shows that October, November, December more than make up for the loss in September. There's always a reason to be optimistic, looking forward, game planning, if this turns out to be the case here, which, based on momentum and the bullish feats of strength here year to date, doesn't lend itself to this outcome, but you can fall into an outlier year. November begins here we are in November, just a couple months away, not even yet. That starts the best 6 months to own stocks historically. Again, going back to 1950, November through April, that 6-month period, going back to 1950, the S&P 500 is up 78% of the time. The average return from November to April going back to 1950 is a 7% return. Hence, it's the best time to own stocks. It's not so bad October through March either, but you drop a full 10% on the positivity rate. So the market is only up 68% of the time from the October to March period going back to 1950. We're close, folks. We are almost, we just got to get through this September. It feels like we've said that just about every month along this winning streak. But either way, there's always reasons to be optimistically cautious on the market. If the S&P 500 makes a new all-time high at any point during the month of September, the average return actually jumps to 1.4% with a median return of 2.2%. We made an all-time high first trading day of September this year. We've made an all-time high. So this may not turn out to be the case if we include this particular data point. 1.4% average return if you make an all-time high in the month of September, which we did. Keep an eye on that 1.4%. You're going to see that pop up in several of our charts and studies here today. But also keep in mind, always buy corrections. That 1.4% data statistic, if you will, is in keeping with what we also discussed last week. When the S&P 500, the first half of the year, the gain is greater than 13%, the monthly return for September is, again, 1.4%. So already at the beginning of our weekly State of the Market, we have two statistics that tell us we should actually be looking for, based on the current conditions in the market and the achievements year to date, we should actually be looking for a 1.4% return. And the market is positive 67% of the time, assuming that we have a first half return of greater than 13%, which we did. We had a 17% return through the month of June. A good start to the year, that's basically what we're talking about, right? A good start to the year could mean a strong finish. These are the 10 best starts. This is from LPL Financial, the 10 best starts to a year ever for the S&P 500. Year-to-date returns are 19 to 36%. Best start to the year was 1987. It certainly did not end well. But that's a 36% return. We're looking at, we have a 20% return year to date. That's 16% above what we've done. Like, I get it. Stop already. History says that great starts to a year tend to see continued strength the final 4 months. Looking at the previous 10 starts to a year, the final 4 months have gained 8 times, only down twice, 1986 and 1987. Been a long time. That's almost 36 years. 2021 ranks as the 6th best start to a year ever. The previous top 10 best starts to a year averaged a return of 4%. But if you take this bad boy out, you're at 5.4% median return. Most important is the percent positive rate. 80% of the time the market is up. 80% of the time, the final 4 months of the year, the market is higher. That's what we care most about. Whatever it does in the way of the return, that doesn't really matter. You're likely not buying the S&P 500. You're trying to pick good stocks. Good stocks will go up if the market goes up. And 80% of the time, it does. The rest of the year, according to the top 10 best starts to a year as of end of August. Corrections, right? Few and far between, 0 between. As shown above, it has now been 307 calendar days, 210 trading days since the S&P 500's last 5% pullback on a closing basis. Over this time period, the index has rallied 38.75%. This is not even the longest streak in history. We just came out of one from late 2016 into 2018, 578 calendar days. So this is not an anomaly. I mean, here in the 90s, these two streaks without a 5% decline were, one was over 500 calendar days, one was just under 500 calendar days. And then you have to go back to the 50s and mid 60s. So not an anomaly. We're almost to the 2003, 2004, which was a little bit, maybe 320 or so calendar days without a 5% correction. Refresher. Last week we talked about, what are the probabilities that we're going to finish higher, based on the fact that we haven't had a 5% drawdown. When the S&P 500 does not have a 5% correction year to date through August, the fourth quarter and September to December are up 100% of the time. 100 September to December, the market is up 100% of the time. The Q4 return up 100% of the time. So just because we haven't had a 5% pullback does not mean that bad things are going to happen. 1987 is not in here, folks. That particular year, you did have a 5% drawdown before September. So not in here. And you could make the argument, knowing that statistic, that this is not like 1987. The peak drawdown, right? September to December drawdown from the January through August peak. There's a 6%, 7%, 5%. The average drawdown, given the criterion we're talking about, is 4.2%. The median is 3.9%. But again, there are 7%, 6% drawdowns, a 9% drawdown in 1959. More recently, and since 1989, though, we're looking at 5% or less so far as the drawdowns in the September to December timeframe, given that we haven't had a 5% correction year to date through August. 100%. Like, could this be an outlier? Could this be the first time in history, this particular quantitative data study proves, less than valuable? Yeah. The historical data does not guarantee future returns. It helps you with probabilities. We've talked about the 5-day winning streaks. Also wanted to refresh us on those, right? Because we're coming off of a 5-day winning streak in August, and we haven't really had, much of a drawdown off of that, but it still lingers. Okay, so here's the chart. From July 1, 2, 3, 4, 5, 6, 7. The longer the win streak, the bigger the drawdown was. We had another 5-day win streak, 1, 2, 3, 4, 5. A less of a drawdown, but we still kind of hesitated here. 1, 2, 3, 4, 5-day win streak going into mid-August, and we had a nice drawdown. Like, we give up some of the gains. It's more time consolidation than price consolidation because we just make higher highs. But this was yet another from 819. 1, 2, 3, 4, 5. And the hiccup here. And we've taken off. But now we're down 3 days in a row. Down 3 days in a row. Today could be the fourth day. And we may, try to give back some, if not all of these gains from this 5-day win streak, which is highlighted, in this elongated 1-year chart here. We usually do 5-day win streaks. We usually do give up all of the gains, most of the gains, all of the gains, and that leaves us where we are today. So maybe this is the point in September that provides the seasonal tailwind to give up, a significant portion of these gains. What's represented here off to the side is where this 5-day win streak started. 44.05 was the close on 8/19. By the way, that's 15 days ago. 15 days ago, 44.05. If we go back and test that level, give up these gains, consolidate for time, and then take off again, don't be surprised. But I guess the key point here is don't lose sight of the quantitative data here. Be able to take advantage of this potential drawdown back to where this 5-day winning streak started 15 days ago. What else does the market like to do? For whatever reason, whole numbers, right? And algorithmic markets like whole numbers. The S&P 500 may have a reason to stall at this point yet again, as the index trades at a level that represents around 300% return over the past 120 months, which is 10 years, rolling 10 years. The graph shows the S&P 500 stalled out at the 100% and the 200% area. So here we are at the 300%. Round numbers, folks. History, human behavior. We'll see. For the sake of sentiment in the market, coming into this week, first trading day of the week on the 7th, the 25-day average daily sentiment index, DSI, stands for Daily Sentiment Index of the NASDAQ 100 and the S&P 500 DSI, were above 83. It's not the end of the world, but it is very bullish. And sometimes, you see a correction shortly thereafter. Corrections shortly thereafter. Downturn here. Hiccup here. Of course, DSI did not, cause the 2020 pandemic crash. But here's another time. You had a hiccup here. It's nothing to be worried about. It's something to recognize just as a condition of the market when things get, when sentiment gets this strong, when market breadth gets this strong, we typically do have price consolidation. We go through these studies, we go through these charts, we go through, the qualitative analysis in order to distinguish between a normal, healthy, to be expected correction and or if something is actually going wrong. Based on this, we should see some type of corrective activity or consolidation in the market. It's also Labor Day week, right? We talked about this last week. Kind of a heads up, right? S&P 500, the last 20 years, Labor Day week, the average return is down 0.25%, give or take, right? Any other week, the market is usually up. But Labor Day week, not so good. And the percent positive rate over the last 20 years, it's a coin toss, up or down 50% of the time, but the average return is still negative. Still negative over the past 20 years, Labor Day holiday shortened week, September. There's just a lot of stuff that lends itself poorly to trading and expected returns in the month of September. Unless, of course, you're bearish, then you're happy about September's finally here. This is my Super Bowl month, right? That's what the bears are probably thinking. The S&P 500 is roughly 0.50% off of its all-time highs presently and seemingly living up to its Labor Day weakness. That weakness may spill over into next week, which is monthly options expiration week. That's September seasonality. We talked about this at the beginning of, or mid-August, I should say, our August research report. This chart right here is the S&P 500 with options expiration week highlighted in yellow. And more often than not, you can see what's happening where those areas are shaded. Market's going down, right? 10 out of the last 13 monthly options expiration week. No, I won't say that 10 times fast because I cannot. The market has been down on options expiration week, right? That's a pretty good, win rate, so to speak. Like 80% of the time, the market has been down monthly options expiration week over the last 13 monthly cycles. So far, we're down this week. We've got one more trading day to go, Friday. Things aren't looking great today. This could spill over to next week. It's about game planning, having the information. If you have the information, you can game plan. If you don't have information, if you don't have resources, you can only game plan what you know. It's what you don't know that counts probably more. All right, consecutive days. Greater than 75% of the S&P 500 stocks are trading above their 200-day moving average, right? That's a huge win streak. More than 200 days now, where 75% of stocks are trading above their long-term 200-day moving average. That's a solid trend. It speaks to the long-term trend in the market, the breadth in the market. We came into today with 76%, so we're close. We're skirting this achievement at the moment at 76% of stocks trading above their 200-day moving average. We don't know if the current bullish sentiment will subside or remain through year end. What we do know is that it has helped in fueling long-term market breadth. Impressive runs continue. The S&P 500 has now gone 216 days. So it's 260 days, greater than 75% of its members are trading above their 200-day moving average. And that's well above the 2013 streak. It's now closer to the all-time record in 2004, which, as you recall, we were just talking about not having a 5% correction in 2003, 2004. Is greater than 75% of stocks trading above their 200-day moving average an important benchmark? Well, this person thinks we're in a bubble. S&P 500 stocks are above their 200-day moving average. Insanely extreme, according to the chart above from Charles Hugh Smith in an article published on, of course, Zero Hedge, titled, "Is Anyone Willing to Call the Top of the Everything Bubble?" Take a close look at that chart while I narrate. Clearly, this is a market participant disgruntled with the state of the cyclical bull market. Earlier this year, more than 95% of stocks were trading above their 200-day moving average for 18 days, right? That's a record. This was a record streak dating back to the 1990s. Former streaks are labeled here Bubble 0 or Bubble 1, Bubble 2, housing crisis, dot-com bubble. Terrible sample size, because that's what he's saying. He's using a sample size of 2. And apparently, strong breath is a sign of a bubble. Okay, you got me, but, it is what it is. Here's what Andrew Thrasher says about all these bubble comments and definitions, if you will. Not every bubble must immediately pop, and not everything that appreciates in value is a bubble. Leave that word to market historians rather than let its toxicity and meaning cloud your vision. Is there really anything you can do with this today? Do you like a sample size of 2? I surely don't. Do you like somebody assuming the market's in a bubble because of strong breath? And you have to go back to earlier this year when it had this achievement. But we'll look at another study. And this one is one that we've tracked at Phenom Group. What happens next when the S&P 500 has 61 consecutive days, greater than 80% of S&P 500 stocks above their 200-day moving average? Greater than 80%, not his 95% chart, and not even this chart, which is 75%. We kind of cut it down the middle at 80%. But for 61 consecutive days, right? It happened February 2021, But it happened again in June. On June 2nd, it ran that streak again. So in March, this streak actually ended. Market had that brief correction of 5.8%, but not on a closing basis. The drawdown was only 4.2% on a closing basis, but it did drop 5.8%. But it ended this particular streak. And then it did it again, though, shortly after. It did another 61 consecutive days of greater than 80% of stocks were above their 200-day moving average. But let's forget about the second streak in the same year and just focus on this timeline. So from February, 1 month later, market's up. 2 months later, 6 months later, 9 months later. Look at the positivity rate, folks. 100% of the time. 86% of the time, the market is up 6 months later, 6.12% return. But, you know, a lot of this, because you see double digits here 6 months later, which is where we are, right? Like February, March, April, May, June, July, August, right? That's 6 months. We've actually gained more than 7%. But there were, you know, years where this breath signal occurred and you had double-digit gains. Should it stop? Look at 9 months, right? That'll basically take us to December. 9 months, there's a 9% return. Positivity rate. Focus on the positivity rate, right? That's what we lean into. The probability that the market's higher. 86% of the time, market is higher. On average, 9% return after this criterion. 80% of stocks trading above their 200-day moving average for 61 consecutive days. That is strong long-term breath. 1 year later. So next February, but don't forget, after this ended, it happened again. Triggered on June 2nd. I think this is somebody just trying to fit his personal narrative, right? Charles Hugh Smith trying to fit his personal narrative, personal bias with some likeness to, and there's a lot of stuff that we can literally, I mean, there's tons of stuff that we can look at. You can look at stock issuance. Stock issuance is probably going to be greater here than it was even in the dot-com bubble. I mean, you know, how many things do you want to tie to the dot-com bubble, but still yet just have like a sample size of maybe 3, including the current year. All right, and we're talking about bubbles, and again, don't forget this study. The word bubble is a term of art. No definition is perfect, including 24-month rate of change. Bubbles are perhaps best defined in the negative, right? Most people talk about bubbles because they, it's going to pop. It's a bad thing when it pops. It's broken. It's irreparable. Market is not a bubble. It doesn't have that capability. Market is more like a tire. You may have heard me say that before. It can inflate and deflate, but it's going to inflate again. And it'll deflate again. It doesn't pop. It's not irreparable. The bubble isn't, the bubble term is used to generate fear, anxiety amongst investors. Call attention to your narrative, your bias. An orderly trend is not a bubble. Folks, here's 1998 NASDAQ to 2000 in red and the present day in purple. Does this look like a bubble today? This looked like a bubble. 24-month rate of change was greater than 100% in the NASDAQ from 1998 to 2000. This does not look like a bubble, folks. An orderly trend is not a bubble. Comparing the 2020-2021 NASDAQ with the 1998 to 2000 NASDAQ identifies an orderly trend. Gradual ascents lack bubble mentality. This was bubble mentality. This is not. This chart from Mark Ungwitter, basically shows you what people try to do in social media as well, right? They put up these linear scale charts. This is the S&P 500 in yellow here. And this is the S&P 500 log scale, which is what you look at on a daily, but you should be, if you're looking at a linear, you need to adjust your settings. You're creating your own problem. You should be looking at the log scale in purple here. But this is what people try to do in social media. If you want to, here's another likeness to 2000. You want to talk about bubbles, you want to, do comparisons and whatnot. Here's another way. The staples weight in the S&P 500 near the March 2000 record low. So, what is investor risk appetite like right now? And what can we compare it to? We can compare it to the dot-com period. Because staples are defensive, utilities are defensive. Right now, the consumer staples sector has its lowest weighting in the S&P 500 since the dot-com period. Here's today, here's dot-com. It just tells you the kind of risk appetite in the market today. Do you want to go against that though? I mean, this is a message from the market based on, millions of investors around the world. Is that what you want to battle? And what for? What's the reward? Lean into the probabilities. Contrarian participation rarely works. And the odds that it's going to work at the time that you, as an individual trader, are contrary in the market are very, very minute. All right, so if we are going to get, some price, consolidation and everything, we talked about sentiment being, excessive at this point. Well, on the first trading day of this week, we also looked at this particular breadth indicator, the NYSE percent of stocks above their 200-day moving average relative to the percent of stocks above their 50-day moving average, and recognizing we've had the best interim breadth pretty much all year. Like, it doesn't get much better than this if we're looking at the current calendar year. We should expect, a little bit of weakening in the current cyclical bull market at this point, in the interim breadth. And again, maybe that's what we're getting. We're not surprised. That's why we look at these charts. But again, it goes back to based on what we're looking at: charts, studies, sentiment, breadth. They're telling us this is normal. Any corrective price action at the index level is normal and to be expected. We're not seeing, issues, that it's like out of the blue. We're not seeing anything out of the blue, out of the norm. This is what we should expect: normal price consolidation. And we look at a lot of different, sometimes it can become overwhelming, right? I've just thrown 2 or 3 different studies at you here in the weekly state of the market, and probably 10 different individual statistics related to September. Can we kind of consolidate it down into maybe one market index composite indicator? That is what Andrew Thrasher at Thrasher Analytics has done for us. And he basically takes, breadth, sentiment, volatility, combines it into one indicator called the Market Health Report. And these are the different, indicators that are different studies, if you will, on breadth, volatility, and trend that he puts into this Market Health Report composite index indicator. And it basically looks at the 15-day. Remember, I said we're 15 days from the start of that 5-day win streak in the S&P 500. Today is day 15. The 15-day lows were common areas the market hit a fork in the road to either be near a reversal back higher or to begin a possible, more protracted move lower. With that key understanding, 15-day lows became the time when we take the market's temperature and evaluate what the market health report is showing. In simple terms, if the market health report has a reading of -5, it's bearish. Above 7, bullish. Example, right here, the March 2020 drop. So the market health report or indicator is the purple line here. And you can see some negatives, negative. This is not right? -5 is bearish. This is only -3, -2. Buy the dip, we went higher. Buy the dip, we went higher. Again, this is the 2020 calendar year. This is 7 where it dipped, went higher. -4, it's still not bearish, and the market went higher. It did get bearish here. -5, -6. We can expect, based on the market health report, that the declines could become even greater. So that's one example, but you probably only care about right now. Right now looks a lot like 2017, right? I mean, we didn't have a 5% correction through all of 2017. And again, the purple line is the market health report. We did have minor dips, 2.5%, but nothing more than that, really. 2.5%, 2.75%. That was it the whole year. And you can see 11, 4, 3, 5, 3, 4, 5. Nothing, market. Those are dips to buy. Went higher. Okay, here we are this year. Here's our dips. -3, -4. Market rebounded. -2, 1. Rebounded. -4, 8, 3. Buy the dips. They're going higher. 9, 4, going higher. Again, the market health report is a composite of breadth, sentiment, volatility. So far, every dip suggested investors to buy. So nice composite there. Phenom Group has its own. Ours is more macroeconomic and macro fundamental. Is the economy expanding? Buy the dip. Credit spreads not blowing out, widening rapidly? Buy the dip. Earnings still growing? Buy the dip. Yield curve not inverted? Buy the dip. As a fundamentalist, myself, who studies and utilizes multiple disciplines, investors are better found aligning with Phenom Group's macro fundamental composite indicator, aptly named by the modern farming dip, which is a Christian way of saying, don't put it in the chat box, folks. As we are live here today, Thursday, 3 o'clock, market's still open. High yield credit spreads remain at their lowest levels in more than a decade. The yield curve remains with 100 basis point spread between the 10-year and the 2-year yield. While the economy may be moderating to a more normal GDP pace, it is still expanding, growing jobs, and found with an extremely healthy consumer, even as the reflation solidifies. Earnings estimates continue to rise for 2021 through 2023 periods by the modern farming dip. Here's a study from the Yale University School of Financial and Economic Management. U.S. buy on dips confidence. It shows the difference between institutional and individual investors. So the buy the dip confidence index is pretty high right now. Investors of all classifications have a great deal of confidence when it comes to buying dips. What about confidence in a crash? Well, individual investors have less confidence that the market's going to crash. Institutional investors have a higher confidence. They believe there's a higher probability the market could crash, but it's still modest, and it's been at the same level since February, basically. Renaissance macro economic data exceeded expectations for much of 2020. You guys have heard me talk about the Citi Economic Surprise Index. I hate this. I hate this index. It's ridiculous. Economic data exceeded expectations for much of 2020. Down here is the CESI, City Economic, it's the acronym CESI for the City Economic Surprise Index. And you can see 2020, record levels for the CESI. And now it's below zero. Goldman Sachs, Morgan Stanley, they've taken down economic forecasts in light of recently weaker than forecast retail sales and jobs growth. Today's deferral and spending is tomorrow's consumption. That's not an opinion, folks. That's how it works. If there are fears about Delta, if there's fears of getting on airplanes and maybe going to restaurants and spending on leisure and hospitality, hotels, vacations, that's just deferred. That's deferred spending. It will either get spent on other areas of the economy, because those are more service related. So maybe it's going to get spent on goods. Or it's just going to get deferred into the future. Moreover, and as shown in the chart from Renaissance Macro, these conditions with respect to the CESI, these conditions have no significant impact on the S&P 500 returns. The market is not the economy, and the economy is not the market in real time. Look at, it's been falling. S&P 500 is going higher. Oh man, it's falling here. It's below zero. Look at the market, still trending higher. Still going higher. Normal, to be expected, hiccups along the way. These low readings don't mean anything. The economy is not the market. That's why I say I hate that index. I hate that index. It's useless. In my opinion, this was analysts being pessimistic about the reopening of the economy back in 2020, where economic data far exceeded economist expectations. Now the economists are too bullish, and the economic data is undercutting economist expectations. They're wrong here. They're wrong here. They can't get right. From one of my favorite characters from the movie Life. I don't know if anybody, with Eddie Murphy and Martin Lawrence. Life, great. It's a long movie, but a great comedy, dramatic comedy maybe. One of the characters is named can't get right. He can't speak. He's a mute. But economists just can't get it right. They're either too pessimistic or too optimistic. That's all you can really capture from the City Economic Surprise Index. All right, sentiment trader, Jeffrey Geffart. Sentiment traders macro fundamentals. Sentiment traders macro index combines 11 diverse economic indicators to determine the state of the U.S. economy right now. New home sales, housing starts, building permits. It's a lot of economic data, right? Now, it's just gone from a high level to a low level, 0.64 down to 0.46, right? So bad things must happen, right? Well, not so fast. At the end of August, Sentiment Trader notes that the macro index model dropped from 0.64 to 0.46. And here's what they have to say. If we consider the price trend, right, the price trend, market trending higher or lower, obviously we've been trending higher for the S&P 500 index. When the macro index model drops below 0.46, as it just did, a different pattern emerges. Previously, when the macro index model has broken down, while accompanied by price strength, stock market performance going forward has been fairly robust. Robust, fancy word for good, like what happened last year. How is the economy doing? We had, retail sales, folks. Retail sales. We talked about Johnson Redbook retail sales. Why are, this is a macro fundamental. We're going to get retail sales next week. I think Tuesday or Wednesday next week. The last July report was rather, it undercut economist estimates. It's one of the reasons why Goldman Sachs and Morgan Stanley lowered their economic GDP outlook for the Q3 period. But you can see here, the pattern that we had talked about in the past regarding the child care tax credits is ongoing. It's exactly what we've expected to see. You get a fall off into the beginning of the new month, You get the surge in the middle of the month when those child care tax credits are received by the households, right? Middle of the month, we start surging. We peak in the final week of the month, then we fall off into the new month. But then we get those tax credits again, and it's off to the races. What you'll notice here about August is the candles, the mean average is actually higher than July for the 4 weeks. So maybe we're actually going to see a positive print. It depends. This is only, Johnson Red Book is not as big of a sample as the Census Bureau's data. But what we're seeing in the data does not look concerning when it comes to consumer spending, which is 3/4 of the economy, basically. Bank of America upwardly revised their year-end price target for the S&P 500. Remember, they were at 3,800 all this time. They finally raised it to 4,250 from 3,800, but they still expect a market correction of 6% into the year end, which flies in the face of all of the data that we've discussed here in this week's weekly research report. We'll see what happens. Again, the historical data, the quantitative data, it's not a guarantee of future returns. But the probabilities are pretty favorable for the market. Maybe there'll be an exogenous event that happens here between now and then that disrupts all of the data we discussed. With that being said, got about 45 minutes left in the trading day. I hope everybody has a good trading week, what's left of it, and we'll see you next week here on the State of the Market. Have a good one, folks.